A man puts $10,000 into a savings account. He does everything right. Doesn't gamble it. Doesn't waste it. Doesn't even touch it. 10 years later, he checks the balance. Still around $10,000. And somehow he's poorer. No thief broke into his house. No hacker emptied his account. The number never changed. But the value did. Quietly. Constantly. Invisibly. This is one of the strangest things about modern money. It can lose value even when absolutely nothing happens. No stock market crash. No war. No economic apocalypse. Just time. And the reason starts with a simple question. What actually gives money value? Most people assume money is valuable because governments say it is. Not really. Money works because it lets you trade your time for other people's time. That's it. A $100 bill is basically a claim check on human effort. Food, fuel, rent, labor, materials. But here's the problem. The number of dollars in the system keeps growing faster than the amount of real stuff those dollars can buy. And when more money chases the same amount of goods, each dollar quietly becomes weaker. Imagine a small island with 100 coconuts and exactly $100 in circulation. Each coconut costs $1. Simple. Now imagine the island suddenly prints another $100. Nobody worked harder. Nobody grew more coconuts. Reality stayed exactly the same. But now there are $200 chasing 100 coconuts. Suddenly coconuts cost $2. The coconuts didn't become more valuable. The money became less valuable. That's inflation. And modern economies are built to create it on purpose. Because a tiny amount of inflation keeps the system moving. If money gained value over time, people would stop spending it. Why buy a car today if your cash will buy 2 cars later? Why invest? Why risk anything? Economies slow down when people hoard money. So central banks aim for a steady erosion. Instead, usually around 2% a year, which sounds harmless. Until you stretch it across decades. At 2% inflation, money loses roughly half its purchasing power in about 35 years. Half. Your grandparents experienced this in real time. In the 1970s, the average American home cost around $23,000. Today, it's over $400,000. Now yes, homes changed. Economies changed. Salaries changed. But not enough to fully explain the gap. A huge part of the difference is simply that the measuring stick itself shrank. The dollar changed. And here's the strange irony. Governments often need inflation. Because modern economies run on debt. And debt becomes easier to manage when money slowly loses value. Imagine owing someone $100,000. Would you rather repay it with dollars that become more valuable every year? Or dollars that become weaker over time? Exactly. Inflation quietly helps borrowers. Especially massive borrowers. Like governments. Which is why the system rarely fights inflation as aggressively as people think. Not because inflation feels good, but because the alternative can feel worse. Deflation. Falling prices. Falling wages. Frozen spending. Debt becoming heavier every year. Economies don't usually collapse in explosions. Sometimes they slowly suffocate instead. And that's the uncomfortable truth hiding behind your wallet. Money is not a stable object. It's a moving system. A negotiation between governments, banks, businesses, and human psychology. So when your money loses value even when nothing happens, something is happening. The system is doing exactly what it was designed to do.